Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, passionate investing community. Today, I have the pleasure of interviewing Zach Zimmer, founder of The Passive Life. If you haven't tuned in lately, you'll notice that I changed the billboard of the show to highlight my soon-to-be released book, Passionate Living Through Passive Investing. And at The Foundry, we'll never lose our focus on leaders, entrepreneurs, and founders. However, we're also interested in ensuring that the wealth we're building isn't just a number. We are adamant about ensuring that improved finances translate into wider vistas and better relationships with the people we love. And yet, work is not something to be avoided. Work is soulcraft, makes us better and stronger people. So I'd like to start by reading a snippet from Zach's LinkedIn, which puts these values into perspective. So he says that he's primarily focused on family, friends, traveling, golfing, exercise, and other self-care activities. When I want to work, I'm focused on building my real estate business, partnerships, private equity investments, and money lending. So now enough about me and my upcoming book. Time to get back to our guests. Zach's journey from climbing the corporate ladder to achieving a 1%er life, retired on passive income before 40, is a simple story. Simple, but not necessarily easy. Initially following the traditional path of education and career, Zach then took the red pill, changing his mindset and actions to build a portfolio of rentals, cash flowing more than 4 times his corporate director role in just 6 years. He then focused on diversifying and multiplying income streams through syndications and money lending to further expand this new life with an abundance of time and cash flow. So now it's time to welcome our guest. Welcome to the show, Zach.
Hey, thanks for having me and that lovely introduction.
Yes, good. Well, I'm very curious to hear what you think about work. And in a couple of questions, I think we're going to dive into that. But first, we need to get to know Zach Zimmer. So suppose you're at a cocktail party and somebody asks you, Zach, what do you do? Tell us how you answer.
I have fun, right? I do what I want to do. You could say, oh, I help people own homes, right? Because I do rent with purchase option on my rentals. You could say I move money around, right? Because that's the main thing that I do. I send wires, I collect money. So you could say I just keep my money moving around. You could say keep the money moving. That was a very cheesy thing that I heard at one of those horrible conference upsells, right? Hey, this is a free conference, and then you have the $900 conference, and then it's the $30,000 that they try to.
Yeah, we're going to talk about that too in a few minutes. I'm looking forward to that.
But one of the things that he said was you got to keep that money moving, and he would lean back like he was throwing a lasso, and that just stuck with us because we just made fun of like the whole spiel of trying to open up credit cards in the back of the room. But that's really what I'm doing. I keep my money moving. I never want to buy a job when I send my money somewhere, right? If I want a job, I'll go back and get a job. If I'm putting my money to work for me, it needs to be passive. It needs to be enjoyable. So, I never want to buy a job, and I just want to compound, grow both my money, my wealth, as well as like my relationships and my self-development. I'm very focused on like health and fitness. And all things kind of, focused on passive enjoyment, right? The passive income life is the kind of the brand that I've started, and trying to teach others, right, of getting out of the rat race and taking that red pill like Keanu Reeves in The Matrix.
Yeah, I love it. Well, hey, let's talk more about that red pill. Figure out how to get the passive income. So I love the way you say it. Simple doesn't mean easy. So it is a simple formula, but takes some doing to get there. And I know so many of our listeners are on that journey to passive income nirvana. So they dream of a day where they can enjoy the same freedoms that you do. Yeah, why don't you walk us through that story of reaching passive income nirvana by 40 years?
Yeah. So, I came up with that simple, not easy, because my upbringing and education was in complex subjects, right? Manufacturing engineering,
Yeah.
continuous improvement, Lean Six Sigma, right? I went through all sorts of education, certification programs that, whether myself and my parents paid for my education, or then companies sent me to get MBAs and Lean Six Sigma, Green Belt, Black Belt, Apex, supply chain expertise certifications, things that were complex. And that's what I did up until 39 in 2019. I bled for companies. I did what I thought we should do. We go get all the degrees, we get in early, we stay late, we go in on weekends. When you're in manufacturing, generally your plants are running 24/7. And so, yeah, you need me to fly somewhere in the weekend. You need me on a phone call because we're having problems Saturday at 10 p.m. I did all these things, leading teams of up to 17 engineers across the country. So, high stress, high complexity when you talk about aerospace manufacturing, right? And the things that go into that. When you talk about, offshore oil and gas, metal components that are going 10,000 feet deep. So it was very complex. And then I found real estate in 2012 was when I was kind of first introduced to cash flowing rentals in Ohio. And I was very fortunate. Didn't know it at the time how fortunate, but as I learned that Northeast Ohio, top five in the country in rental returns. And people don't know, but Ohio is like the seventh most populated state in the country. I mean, this is a kind of a Midwest. Yeah, our weather is just kind of blah, but it's a great Midwest powerhouse for rental returns and property values that are just so achievable to go and purchase. And so I heard about it just through work. People at the company where I was at, we had a nice bonus program, and people would take those bonuses and go buy a duplex or a single family. And so I started to look into that. And I remember it was before I had the funds. My wife, we were married, we were dinks, double income, no kids, making a good income at that time, probably around 120,000 in 2012, which you're talking a little bit more than double the Ohio median income. So we lived a nice life, and we spent everything, right? You got a raise, you got new furniture, you redid your patio, you took vacations. Maybe we were saving. We were doing 401ks, so we were doing 15%, 10, 15%, and then really nothing else. So in 2012, I remember going to my dad, and my dad was pretty successful small business that my grandfather had started. And I went to my dad and said, "Hey, I want to buy a property. And, here's all the numbers, and it's a duplex." And again, this is my first thing I was ever looking at. And I was just told, go find these nice duplexes for 40 some $1,000s, and each side's going to rent for 525. And at that time, I didn't know a lot about areas, but now, that area I was looking in was like C minus. And I went to my dad and said, "Hey, I just need this loan, and here's how I'll pay you back and all this." And my dad said, "Nope." I was like, "What? What do you mean? You just don't get it, Dad? Come on." And I was a little upset. But in hindsight, it's the best thing that could have happened. Had I bought that C minus duplex, it very possibly could have been a disaster and ruined my whole taste. But I learned over the next couple months, single families, you're going to get a higher rent, a longer staying tenant. And
Right.
then I learned about rent to own, rent with a purchase option. And I said, ooh, so I'm not responsible, like when they clog their toilet or when they break their screen door or when they do these things. And so I'm not going to be a landlord.
So that's really the opposite of your C minus deal. I think you described that previously as more like a D. And dig in a little bit. I mean, those numbers or those deals, they always have great numbers. Hey, if you can believe them and if you can achieve them, and if you're willing to go through all of the hassles, I mean, you're really buying yourself a job when you have D-class property.
Yep. And I didn't, I didn't know anything, and there wasn't bigger pockets back then to read about others' experiences in 2012. So it was just, okay, here's what I hear from some people. And there was no good education or podcasts, at least that I was aware of at that time. And so just,
well, the Foundry had not been initiated yet. I think we were recently number 20 on FeedSpot's top 70 apartment investing podcast. But anyway, sorry, go on.
Yeah. Now, so by the time my bonus came in March, I got about a $20,000 bonus being an engineering manager. And I had already started talking with a lender at Huntington, and they were like, oh yeah, they looked at our U2, W2 kids. Oh man, whatever, however many loans you want, what do you need? And so I lined up a property in Akron, Ohio. And it was back then the banks were just doing everything. They were painting, they were carpeting, they were fixing everything to get these properties to move. And so the first property was a $40,000 1700 square foot, 3-bed, 1-bath, nice property, turnkey, new carpet, new paint. And Huntington, did a 30-year fixed mortgage. And I remember after about a couple days after having it under contract, another property popped up 2 blocks away that was a 2004 built house, 4-bedroom, 2-bath, stainless appliances for $50,000. And I was like, oh my goodness, like this is ridiculous. So I went back to my Huntington broker. Hey, could we get 2 loans? Yeah, whatever you guys want. So our first closing was 2 single families, and it took pretty much every dollar of that $20,000 bonus to buy those on those 30-year fixed, whatever the fees and everything were and down payments. And, those first couple of purchases, the title costs that those companies charged me, since I knew no different. So like every little fee they throw in that they don't charge to, high volume investors like I pay now. But yeah, that was the first 2. We rented those at like $850 and $950. And so it was cash flowing about $500, $550 a month between the 2 of them. And I was like, okay, hey, this is our weekends. Yep, our weekends going out. And in 18 years, we can sell these. We were pregnant at the time. I was like, hey, in 18 years, that's going to cover a big chunk of college. We don't have to worry about saving for college. And that's all I thought this was. It was like, I spent the money I had, the bonus. And I was like, okay, it's a little bit of cash flow for going out, and it's a college savings plan. So I don't have to worry about setting aside any money for that. And, when people ask me, oh, what was the light bulb, the biggest decision, it was buying those first 2 instead of taking vacations and buying furniture, right? Yeah. Every decision after those, once we started to realize what this could be, was easy. But when you didn't understand what this thing could do, and you were pulling $20,000 away from vacations or a new car or anything that you do as double income, no kids spending, that was the biggest jump that we took.
Right. Well, a lot of great things in that story so far. I mean, a good deal or a bad deal, I should say, will hurt you a lot more than a good deal will help you. And having a good first deal really matters a lot. I think we're going to get into those gurus that open up credit cards in the back of the room in a moment, but who will tell you just the opposite. But that's really the way you got to go. And then you mentioned your market. Now I'm broadcasting here from Michigan. Interview a lot of Ohioans. Just had Lee Yoder on the show a while back. Some great markets out here in the Midwest. I mean, you mentioned buying duplexes for $40,000. If you And you wouldn't necessarily think of Akron as necessarily being, your class A market, but hey, there are huge advantages that you can get in at a decent price point. You can get things that cash flow, you can get things that have great numbers. And not like the crazy class D properties that will keep you awake at night. They can be in a decent suburb with a stable population and a great entry point. So yeah, a lot of great things in your story now, but I know you expanded quite a bit. You went really far down that single family road. So let's pick up the story, and I'd like to hear the next leg of the journey.
Yep. Yep. So the rest of 2012 and really into 2013 was nothing because I didn't have any more money, right? Didn't have a bonus until another year later in 2013. And I just thought you needed money up front to go do this. And so I think I got another bonus. And then I started to hear about lenders that were giving you money up front for the rehab. So community banks were actually giving you funds at closing to cover your rehab as long as your rehab, it appraised with those things done, right? So they would appraise the property and you would say, hey, here's my quote of all these things I'm going to have done. They're going to say, okay, they're going to appraise it based on being done with all those things. And they're going to say, oh, okay, yeah, that property is going to be worth $80,000. Well, I'm under contract and buying it for 35 and I'm only going to have to put 10 into it. So I remember going to like the first closing with that type of loan. I brought no money to the table. They gave me a check for like $8,000 or $9,000 to go buy this house. And that's really all it took. Maybe I had to throw in like another $1,000 to get it done. And now I owned a cash flowing asset, putting, $400 a month into my pocket that cost me $1,000 down because the bank covered the rehab. So I did some of those. And then probably in 2014, I struggled in 13 and early 14 with just, realtors that weren't for my type of product, right? These are your C plus median income, single family homes or contractors. I struggled a lot with contractors until like mid to end of 2014. But once I found the right realtors that understood my model that I clicked with and the right contractor, he's the biggest reason that I had the success I have had. Then it just became a hot rocket ship system where I didn't really look at properties because I got a full-time career with lots of employees. We now have
Right.
2 kids. I'm traveling around the country. So I just got this system. And that's how I look at everything because of my training and education and systems, continuous improvement, data. Like I'm non-value added, NVA, to looking at a property. Once my realtors know what I need and the contractor knows what we do, I don't provide any value going and seeing that property. So I just had my realtors looking at properties or giving the code to my contractor since he had his license as well. And they would go look at them, tell me, yep, it's going to need 5,000 in repairs. Okay, let's get it for 35, 40. We're going to be all in at 46 and rent this thing for 950. And we did a house a month for like the next 3 years to get up to around, high 50, 60 single families by the time, this all ended in 2019 when, I no longer had my W-2 and I felt very satiated with single families. And that's when I really diversified into a lot of private equity partnerships, operating businesses, money lending, and those other avenues, trying to get as many colors in my stacked income monthly bar chart as possible.
Yeah, well, really love the story, and I love the lessons in leadership there. You give people a lot of responsibility, you expect a lot of accountability, and you're able to basically, because of who you are and who you've picked and how you are able to lead the team, to be very hands off.
Yep, that's the key. You don't have the time because I stayed in a market that a lot of people, let's say a lot of the advanced folks, they poo-poo the single family market, right? Oh, it doesn't take you much more time to buy a 10 unit than it does to buy a single family home. And you hear a lot of that. And yep, I'll acknowledge that. Lion and the field mouse, right? The lion hunts gazelle because, right, they provide a lot more energy than hunting a field mouse. And yes, okay, I recognize I've been playing with field mice, but with my rent with purchase option, it's extremely passive. The appreciation growth that I've gotten, it's been amazing. Now the government printed $9 trillion, but if you had assets, right, they fly up. And then the ability to shear the sheep or peel them off, right, by selling one, by the tenants buying them. It's just a nice system versus owning a 10 or 20 unit that, okay, I mean, I have owned some, we owned a 12 unit, and it was challenging, lots of turnover, lots of transient, an older building. And yeah, we were fortunate enough, we turned it around and then just punted it to these, I call them crazy California buyers that are just chasing such low returns. But, when you add it all up to them, it does kind of make sense, but they're willing to pay prices that, are crazy for us here in this market to think about.
Yeah, 100%. So then I believe at some point you started to sell off those single family homes and move into, you did mention some private equity, et cetera. You added some colors to the stack. I think syndications ended up being the largest piece of the pie in that colorful pie chart of yours.
So definitely not from a cash flow perspective, but if you look at from a equity value perspective. So yes, it either had loans up front, or in 2014 is where I started buying in cash, rehabbing in cash, and then burning that cash out. And I eventually moved into packages, taking a 5-house package, all owned in cash, to the portfolio bank. I've worked with about 5 or 6 here. So essentially I ended up having no cash, none of my cash left in a 60-house portfolio, net cash flowing $35,000 a month. So return of investment of infinity when I have none of my money left there. And so that money, right, was moving into a house, moving out of a house, moving in, moving out. Same dollar might have, gone into 8 houses, right? And then, keeping it moving. And then in 2019, I also ended a flipping, I used to flip as well. And so that would take a large amount of cash going in and out, because I've never borrowed hard money or taken anything like that, private money. So when I stopped flipping and I ended a partnership that was also flipping, it left me a lot of money sitting here. And I stopped doing my BRRRR strategy that would take, nearly $300,000-400,000 to go BRRRR 4 houses, 5 houses at a time. So that's when, I started looking for other things and found, syndications. And they were, sexy, man, a golf and winery resort in New Jersey, and an A-class apartment building in St. Pete and Tampa, and self-storage builds in Texas. And I'd never been lied to. I've never had, fortunately, everything I kind of touched in real estate became gold or silver. Everything went amazing. And so I believed all these syndicators, and I believed all these numbers and all these deals. And I funded, like 25 syndications from 2019 to 2023 with 50, 100 grand in each, until there was about 2.5 million, 3 million out there, from cash on hand, as well as a lot of single families that sold to tenants through COVID. Or if I had an ugly turnover and I needed to put 10,000, 15,000 into the house, I said, nope, I'm just going to sell it then. So I'm going to punt it to these California buyers buying things at like a 1% rent to price. So for a house that rents for $1,300, they're willing to pay $130,000. And my basis in that house was 45. So
Yeah.
So I punted a handful.
Yeah, so for those that don't know, that's like your bare bones rule. Like, you want to know if a single family home is worth it, it should pay at least 1% at top line each month. Depends on the age of the home, whether that makes sense. But a lot of them, and it depends on the timing. Sometimes you can satisfy the 2% rule, or
Yep.
or better.
Yep.
But yeah, okay, good. Yeah, well, I say anytime you can sell those California buyers, do
Yep.
it. Keep the
So
money
that's,
moving, I guess.
yeah. Yep. So, I sold a lot, and some people, oh man, you were getting 550 a month in net cash flow on that house. Well, but what was my return on equity? And so that's, a lot, that's a metric I started publishing and talking a lot about, and I work with my coaching students on. Right. I just sold a house last week that people would love to have. It was clearing about $600 a month in net cash flow, but there was $88,000 in equity that came out of it from the sale. Right. So my return on equity was like just under 10%, I believe. And I can go buy another house in complete cash that's going to hit me about a 21%. Right. I just bought a property a couple weeks ago, $65,000 all in, and it's rented at $13.25. So I took that 9% stuck equity, right? Go buy a house all in cash with it that's now paying out at like a 21% cash on cash return. So, that's a lesson I like to show folks is you have that trapped equity, and yeah, you could refi it, right? You could refi it if that makes sense to you. The way I'm still able to procure properties off market, under market, and extract that value and take like a 9% return on equity and turn it into a 21% cash on cash return. A lot of value is created there, right? A lot of value. So that's how I looked at it through those years. That's how I still look at it today, since I'm still able to procure, definitely not the volume I did, right? I was buying 15, 17 houses a year, putting them into rent to owns at those great returns. There's so much demand here now because of bigger pockets and Redfin and Zillow. Everybody's talking about Northeast Ohio, and Michigan's on there as well, Indianapolis, these Midwest places that now the buyers, the wholesalers, it's just there's 10 times, 20 times the people buying here, maybe 100 times. There's so many more than there
Right, yeah,
was.
these steady Eddie markets are outrunning the rest of the country, not because they're so fast, but because the other runners have just sort of tripped themselves up by getting ahead of themselves with too much appreciation. And now a lot of those markets, particularly down south, I know I have some great properties down south, got some tremendous tailwinds, but now the building is catching up. People realize those are good markets, and now those same markets that gave me such tailwinds in the past now have some headwinds. So yeah, definitely, I like many investors coming home to the Midwest.
So, I did all those syndications, and I just felt on top of the world, right? Single families were printing money. The growth of all these syndications seemed amazing. I was kind of modeling out, hey, I know these guys are saying 20s, but let's just say they grow it at 15% a year.
Right.
Oh my goodness, what's this thing going to become? Like, it's enormous. And I was also doing some local hard money lending. And then in 23, things started to topple. Some hard money lending here that I was doing that was not with real estate investors. They were to businesses. I was a victim of fraud in a couple cases. So I started to, that avenue started to topple. And then the syndications just started. Let's see, I was in a Ponzi scheme that the SEC has gotten involved in, and they're taking control of that one. And then just a lot of bad business plans, guys that saw the cheap money out there, print $9 trillion, lots of people had money. And I was drawn to these high returns. I hadn't found PIC, Private Investors Club, or 506B group, which are two really great groups online where they vet all these sponsors. They talk about all these deals. There's, I don't know, thousands of members in there. And it's like they do background checks. So they validate who you are that's joining. So nobody joins and is like, oh, look at this syndication. It's amazing. And as I found those and did some research into some of the sponsors and some of the investments I was in, I saw like, yeah, these groups do not support oil and gas, right? I went into oil and gas, into two syndications. Both of them have tremendously flopped into some self-storage builds, ground up. And, as the interest rates went up, they lost their financing, they messed up with zoning, and I'm still sitting on 3 dirt plots after 18 months of my money being out there. Capital calls. I've had over 6 figures of capital calls from my Florida and Texas apartments. Just things where their business plan was so tied to a low interest rate, and they only bought it for 2-year or 3-year, and they've just gotten so smacked with interest rates, as well as something they couldn't control was the hurricane and ice storms in Florida and Texas that, boom, caused habitational insurance premiums to double. And those premiums are premium in full with basically a 30-day notice. So I remember I got emails from 4 different places that totaled over $100,000 that they needed me to wire next month, or else I was diluted by an unknown percent for them to go find hard money. So as all those things were crashing, I just said, I'm done. Like, I am back to Northeast Ohio, single families, any apartment partnerships with people that's their market and I'm close to, and just lending to my close friends that are flippers, high volume flippers that need a lot of capital for flipping 10 houses at a time. So because I've just got such a sour taste, and some of it was my fault for just, again, nothing bad had ever happened to me. I'd never been lied to. And I just believed people knew their business plans well enough and believed them, not understanding that these guys were really just after funds. There was so much money out there, and it was a race to, capture funds and build things and buy things. And yeah, I just, to the tune of north of 7 figures in losses and things that are just stuck out there doing nothing.
Yeah, well, they say success is a poor teacher, and I really respect you for talking about some of the missteps. It's, I think, really, you distill an entire podcast down to its essence, talking about mistakes, missteps, and how you overcome them. Probably more important than 10 success stories. But let's move on to one of your success stories, which is the private lending. I think that's very important. People only really appreciate private lending or lending in general when people are losing money on the equity side. And that's something we've seen recently. We have distress, particularly in commercial, as you sort of alluded to, right? Those syndications, a lot of timing. I mean, seeing 50, 70% increase in your equity within a year, hey, that was nice when that worked. And then when it stopped working, it really hasn't worked to that level again. I know I had one that went up 78% in literally 1 year. Didn't mind reinvesting that cash with the same operator. So, on the other hand, we see rate cuts on the horizon, which means that some of these equity positions may be safer. You know how it is. Everybody is most frightened at the safest moment and feels safest at the moment we should be most frightened. But, with that sort of a backdrop, what would you say about private lending right now? Is that something you want to do more of? What do you think the outlook is for lending?
So I really like lending. It is, kind of I call it like, active income is the worst. Unearned income would be the next one, and then passive income would be the best. And so lending, right? You're getting unearned interest income, which is nice. You don't have to work for it, but it also comes with no tax advantages. So, but it's better than working and paying tax. Okay, you don't have to work and you're going to pay tax. But I love it for where to park my short-term capital that doesn't have anywhere better to be, right? I don't want my money sitting in Chase, right? I get antsy when it gets, too low, but then I get antsy as well when it starts getting up high because I know it's earning me nothing. So, I put the large majority of my liquid funds into lending, and mostly because I have a couple close, very close friends that like I vacation with. I take them to my place in Florida. We hang out weekly. That I know nothing is going to happen to. Right? I know their model very intimately. I know them and their families. If I didn't have those connections, it would be a lot harder for me to have nearly 7 figures just lent out to people. Yeah, okay, first position lien. I mean, I'd really have to turn it into a business of going out and looking at properties and getting involved with appraisals and really getting involved to make sure my money is secure. Because I know these people, I don't worry about the security or where my money is. I just know it's with them. They're a great friend, and I get my monthly interest payments, and we have agreeable call terms of how I notify them to get the funds back or portions of it and how they can send it back as well. But it is a great model. If you don't have close people that you trust intimately, then yeah, you need to look at it more as a business and get deep involved in the assets, the appraisals, the values. You need to look at this person's personal credit and do background checks on them. Are there open liens and lawsuits against them? You have to do a lot of due diligence, unlike what I didn't do in syndications, right? I just sent my money to people because they told me their numbers were well and they told me their business plans. And now it's costing me an enormous amount, especially if you look at what that money could have become over the next 15 years. That's how one of my headlines when I spoke was how I lost $14 million. Oh my goodness, this guy lost $14 million. Well, when you take the money that's been lost, right, and you multiply that over the next 15 years at 11, 12%, which is easy for me to do if I'm owning my own single family or I'm lending, that was $14 million of what that was going to become for my estate, for my kids, in the next 15 years.
Well, yeah, I mean, lending is great. I mean, if you're lending out at 12% and you're able to reinvest, rule of 72 of every 6 years, roughly, you're going to double. You can foreclose. So you're probably never going to lose a whole lot of money unless you get in a fraud situation. Like you said, do your due diligence, make sure, check for list pendants, checks for, do a background check, personal credit. You have those things and a decent loan to value. You're probably not going to lose your money, and you're going to see it double many times in your lifetime. So yeah, I think that's great. Definitely something I want to do more of. But anyway, I think I talked enough about private lending in the last episode. We should probably move on. Right, beautiful. And now we just have to make sure that all the beautiful people in the audience, and thank you, beautiful people, for staying to the end, have an opportunity to reach out to you. So what is the best way to reach out to Zach Zimmer?
Yeah, so my website is realzachzimmer.com. That's REALZACHZIMMER, realzachzimmer.com. And I also have a freebie. So they can get my top 5 strategies to 7-figure passive income by texting TPL for the passive life, TPL to 33777.
All right, awesome. Well, accept no imitations out there, people. And I want to thank you, Zach, for taking the time to share your knowledge and experience with our audience.
Hey, thanks for having me. It's been fun.